Hello and welcome to the Scan the Markets webinar with myself, David Madden. I work as a market analyst for Equity Capital and I'm based in London. And Equity Capital is one of the many companies within the overall equity group. We have other branches such as Equity Nigeria and also FX Pesa in Kenya. For those of you who've been online since 6 o'clock, I do want to apologize. Had some technical difficulties. For those of you who regularly tune into these live webinars or watch the replay on YouTube, I typically wear earbuds, but they're playing up the day. The battery was running low, so I had to, at the last minute, swap over to the actual old school headset. But now moving kind of swiftly on. What I'll do is I'll do the usual setup where I do a rundown of about five markets. It'll be big, currency pairs, commodities, and also indices. Talk about the major stories of the day, what's going on in terms of driving the news in terms of fundamental news. And also I'll talk about technical analysis, which is a study of charts, which is an area of analysis that I am really, really keen on. For years, I was much more of a believer in fundamental analysis, but I now believe that actually technical analysis actually tells you far more about the markets. What I'll do is I'll run through a few big markets. If there are any point you have a question about what I'm covering and you don't understand it, feel free to just type in the chat box of the question area to say, would you mind explaining that? I didn't quite get that. Would you mind going over it again? And of course, if there are any markets that I haven't covered in my rundown, if you just want to say, oh, would you mind please taking a look at sterling, sterling Aussie or whatever it is, feel free to just make a recommendation, and I'll happily take a look at some markets I hadn't planned on talking about. The first and foremost I'll be looking at is the British pound versus the US dollar, GBP versus USD. What's going on here? Well, in terms of the big news is there are concerns about the health. Well, there are concerns about the health of the UK economy, and there are also concerns about the health of the US economy. But it's all relative. In this scenario, there are greater concerns about the health of the UK economy than there are concerns about the health of the US economy. And in that scenario, because the perception is the UK economy is cooling down or even potentially contracting at a faster rate than the US economy, that manifests itself in this kind of broad decline that we're seeing here in GBP versus the USD. So it is worth pointing out in the last few hours, you've seen a very volatile US dollar. The US dollar a few hours ago was quite strong, hence why we saw a sharp move to the downside in GBP USD. That has since reversed, and now we're seeing a bit of a rebound. But let's look at the overall kind of price trend. The price action for the currency pair is to the downside. So in the last few sessions, we have seen a strongish US dollar. And that's also been playing into the mix. Although, as I mentioned, in the last few hours, the dollar has retreated from its recent peak. So that's kind of the big kind of fundamental story that's kind of hanging over those two currency pairs. I'll be talking about aspects of the US economy later on in a few charts time when I'm looking at the Dow Jones. But coming out of the more technical analysis aspect of the analysis of the currency pair. First and foremost, I'm looking at a 4-hour chart here. That's the time frame that I'm looking at, and I have 3 moving averages on screen. So this one here is the 20-period moving average. This one here is a 50-period moving average, and this one here is the 100-period moving average. So if we take a look at the price action, we can see the kind of the broader picture for the currency pair is to the downside. So the kind of broader trend is lower. I'll always be looking at the price action of a chart and say, what is the market telling me? And what is the trend? What is the overall move in the market? What is the market telling me? And we can see that the market is in a downward trend. And also, if we look at the moving averages here, even though the price has rebounded from its recent low, it's still holding below all 3 simple moving averages. And while it continues to hold below those 3 simple moving averages, I suspect the longer term, more medium term bearish trend will continue. If we do fall further from here, and we break below the recent low, where can we target? Well, I'll be looking down toward this here at 1.2040, and a break below that could see us back down toward this zone here at 1.1932. Now, even though the more medium-term trend for the currency pair is lower, it's worth noting in the very short term, we can see that the currency pair has rebounded. Looking at this indicator here, this here is the MACD indicator, the moving average convergence divergence. It's essentially kind of a measure of changes kind of in the moving averages, and it kind of offers a visualization of what the kind of momentum is, the rate of change. And as we can see here, we can see here the histogram shows us here that there's a steady increase in negative momentum that then began to peter out, and now momentum has swung back positive. So the bears are no longer in control. The bulls are now marginally in control. So we are seeing a bit of a change around in momentum. Looking here at the RSI, the relative strength index, we can see it was moving lower, but it's since rebounded from the recent lows. It didn't quite get to the oversold territory, but it wasn't too far away from it. And essentially, the RSI is sort of a measure of the kind of rate of change. And if you stay, if the RSI is within these two bands here, the upper end of the band means, if you're moving towards the upper end of the band, typically means the price bias is to the upside. If you're moving towards the lower end of the band, it typically means the price bias is to the downside. And of course, if you move into oversold territory, that could be an indication that the market's kind of overstretched to the downside, which sometimes may or may not lead to a snapback in price. Or conversely, if you move into overbought territory, that can mean that the market was kind of overheated, like we saw here back in mid-May when the market was overheated. And not always, but the market was over, the RSI moved into overbought territory here, which could be a sign that the market's overheated to the upside. And lo and behold, that preceded a pullback, a move to the downside. So I'm not saying it always happens, but it often happens if a market moves towards overbought or oversold, it can lead to a flip around in price. So we're now looking at this price and asking ourselves, is this going to be just like a rebound in price before we have the next leg lower, or is this the beginning of an outright turnaround? Well, if we do manage to move higher from here, where will I be looking towards as a potential resistance point? Well, first and foremost, I'll be looking up towards the 100 period moving average here. This line here, we can see when the market rebounded around the 22nd of June up until the kind of 27th, 28th of June, it was kind of showing early indication it was kind of shaking off the longer term bearish trend. But lo and behold, it failed to kind of properly break above the 100 period moving average. The market ran out of steam. And then as we now know, the selling pressure picked up again. So if we do rally from here, I'll be looking toward this moving average here, the 100 period moving average. That comes into play at one spot at 22.67, and a break above that could see a target here, the peak of mid-June in at one spot 24.27. Now, in relation to the moving average, we can see here that it acted nicely at resistance on this occasion here. If we follow the moving average around, we can see it acted at resistance in this area, in this region here. It acted as a support zone here in early June. Didn't quite act as support in very early June, but the market came quite close to it. And also, if you just move the line back further, you can see it acted as both a resistance and also support back here in mid-May. And what I often say is, if a metric has been of importance in the past, it makes it more likely to be of importance in the future, but although there are no guarantees. And this is precisely why trading is difficult. So what you're typically doing when you're focusing on technical analysis and the study of charts, you're looking at price patterns in the past, what have been the common moves in the past, and will that play out again in the future? So moving away from GBP to USD onto silver now. What's been going on with silver? Well, one of the kind of major themes of the financial market as a whole the past few days and even kind of few weeks is that the global economy is slowing down. We've had updates from the World Bank, the IMF. They've been downgrading global growth forecasts. There are concerns, as I mentioned a minute ago, there are concerns about the possibility of the UK entering recession. There are concerns that the US might enter recession. There are concerns that Germany or maybe even the wider Eurozone might enter recession. And if economies are cooling, that would probably, it's fairly reasonable to suggest that demand for industrial metals such as silver will decline. So that's one of the kind of issues that's been hanging over the markets: recession fears, lower demand. A minute ago, I talked about how, broadly speaking, the US dollar has been strong in the last 3 or 4 sessions. Silver is traded in US dollars, whenever the dollar is strong, that typically puts downward pressure on silver. And conversely, whenever the dollar is weak, that usually pushes up the price of silver. So take a look at the price action silver. We can see it's been moving aggressively lower. It's actually fallen back to a level last seen. We're now back to a level last seen in June 2020. So silver is at a 2-year low. So it really kind of speaks to how bearish how negative, how bearish the move in silver has been recently. Whereas in the last few hours, it's fallen to a 2-year low. So what does that tell you about what traders feel the demand is going to be for silver in the next 3, 6, 12 months down the line? If you're looking at the kind of pattern of the economy, we had obviously the markets came under tremendous pressure in spring 2020 amid the lockdowns. Then we had the reopen. There's a kind of post-pandemic boom. The post-pandemic boom has certainly faded. We're now in the kind of chatter of are many economies on track for a recession. So now we can see the things tapering off. So these are the kind of big stories that's been kind of playing out in silver. We can see, looking at the price action, looking at technical analysis, I would always ask myself the question, what's the market telling me? The trend is clearly lower. You look at the price action in a kind of almost like a 45-degree angle to the downside. In the last few hours, we've had a 2-year low. That really speaks to how bearish silver is. Looking at the MACD indicator, we can see that it's firmly in negative territory, indicating the bears are in control. If we continue to hold below these 3 simple moving averages, where could we move to? We're likely to continue falling. Moving lower from here, I'll be first and foremost looking at 20.00, the next big psychological number to the downside. And if you go below that, I'll then be looking at back to levels last seen in almost 2 years ago, early June 2 years ago, in around 19.24, and below that down towards 17.93. It also says a lot about silver if you look at the price action of silver in early March 2020, before the pandemic struck, silver was trading around 1870, 18.70, 1880. So it says a lot about silver, how it had a brutal fall in early March because in March 2020 because of the lockdowns. It had a blistering rally, and it hasn't fallen all the way back to a level just before the pandemic began, but it's almost has. So it kind of goes to show you that all the kind of the hype about all the global economy is going to be booming in the post-pandemic. All this money sloshing around the financial system, people are going to be going spending, driving up demand, and lo and behold, we've given up nearly all of the gains that were set in the wake of the kind of in the wake of economies reopening. So, to my mind, that kind of says a lot about how quickly sentiment has changed. And also, we probably actually haven't seen the worst of things yet, because we haven't had the real kind of impact of interest rates that have been hiked coming into play just yet. So I'll be looking out for those levels to the downside. I could at the lower end could have 17.93. If we do get a rally from here, because speaking of the RSI, the previous chart, we can see that that's actually moved into oversold territory. So that could be a kind of a warning sign to say, oh, the market's oversold to the downside. We might see a bit of a snapback, because let's face it, markets don't move in straight lines is the old adage. And if you examine the previous price action, you can see there's been several occasions where silver in the last few weeks and months has had a sharp move to the downside, followed by a reasonably sharp move to the upside. Look at the price action here. It moved sharply lower here, creating a multi-month low, only to have a fairly large rally. Look at the price action here. We saw a fairly aggressive move to the downside into mid-June, only for it to have a fairly large rally. As we now know, those rallies didn't actually last, and the market's rolled over on itself. But this could be, the fact that we're now actually moved into oversold territory. This could be the kind of early indication that things are about to actually, we could see a snapback. And if we do see a snapback in silver, where could we potentially encounter resistance? Well, I'm looking toward this peak here in 21.04, and then beyond that up toward this peak here in around 21.52. Coming on now to the Dow Jones US 30, I talked about how there are concerns about the health of the US economy. We've had a number of interest rate hikes from the Federal Reserve in the last few months. The Fed are hiking rates. The cost of borrowing is going up at a time when we can see economic indicators in the US. Some of them are cooling, suggesting the economy is slowing down. So that's sort of a bit of a dangerous combination. Today we saw the US jobless claims report, which is essentially a measure of of the number of people who are signing on for the first time for unemployment benefits. And the jobless claims rate ticked up to its highest level in 4 months. So that could be kind of an early indication, is it, to say there is some weakness creeping into the US labor market, because that's how things go. You have the odd kind of nudge higher. There's a bit of a trend forming, and now we're at 4-month high. In the grand scheme of things, the US labor market is in strong shape, but it could also be interpreted as, okay, we're having a cost of living in the United States these days is expensive. CPI, consumer price index, is at a 40-year high. The cost of living in terms of petrol or gasoline prices, as gas prices as they call it in the US, that's at a high level. Cost of timber for house building materials, that's expensive. Food is expensive. Energy is expensive. This is the sort of thing that kind of creeps in and it kind of hits people's pay packets. Therefore, they can go out and kind of spend less after they gotten paid, and that's what they spend less. That's how it kind of seeps through to a decline in the labor market. What's also going on as well is we have seen a bit of we have seen some what could be seen as positive news or even negative news for the US economy. So the core PCE reading is the Fed's preferred measure of inflation, and that actually dropped today to 4.7%. It was a third monthly decline. Keep in mind, I think the peak a few months back was 5.3, so it's at a fairly significant fall from 5.3 to 4.7 in the last 3 or 4 months. And the fact that the core PCE reading is falling, that could be interpreted that actual underlying demand is actually diminishing. And if the underlying demand is actually diminishing, couldn't that be construed as a sign, okay, the US economy is going down a gear? On the flip side, if the core PCE reading is falling, and which is what the Federal Reserve want, that could then indicate to the Federal Reserve, hey, the work that we've been doing in hiking interest rates is sort of taking effect. Things are going our way. They want the price to come down. And if that is the case, and if it actually really was their rate hikes that helped bring inflation, core PCE down, then surely it's easy to kind of follow the logic that then they might need to actually introduce fewer rate hikes down the line to actually get inflation back to a level where they actually want it. So with that, although could be seen as a sign the economy is getting worse, with the economy is getting worse, the Federal Reserve have less of an incentive to go out and actually hike interest rates at a fairly aggressive pace, which I suspect is why we've seen a sharp rebound in the Dow Jones in the last few hours. But once again, look at the big picture price action. What's been going on in the last few days and weeks? It's clearly a fairly large move to the downside. In fact, the lows that we felt to here almost 2 weeks ago was an 18, 19, an 18, 20-month low was set here in mid-June. We've had a fairly large rebound since, but as you can see, we've had a fairly large move to the downside once again. So we know traders are asking themselves, is this kind of short-term downward trend going to be continued, and are we going to retest the lows that we set here in mid-June, or is it going to be a case of the more medium-term rebound is going to continue and win out? So as far as I'm concerned, if we continue to hold below these 3 simple moving averages, it's likely the short-term bearish trend will continue. A move lower from here could see it retest 30,259, and a break below that could see us back down toward this area here at 29,647. If you can manage to kind of stage a rally from here, an extended rally from here, where could we go? Well, first and foremost, I've been looking toward the peaks here, which all kind of coalesce around this zone here, around 31,158. And then the big level to watch out for will be this peak here, the highest here of late June at 31,883. So if you break above this peak here, that'll be a fairly decent indicator that the more medium-term upward trend is going to continue. It's a similar situation over in Germany and the DAX. The German economy is going through some of the same issues, well, that other economies are going through, slowing growth and higher and rising levels of inflation. This morning, the DE30, the DAX, fell to a new 3.5 three and a half month low, which really kind of highlights how bearish the move is. Looking at the MACD indicator, momentum is in negative territory, suggesting the bears are in control. While we continue to hold below these three simple moving averages, it's likely the more medium-term bearish trend will continue. Moving lower from here, we could look to retest the lows of early March in at 12,433. What's also a factor that's going on with Germany and the wider Eurozone in general is the fact that although the European Central Bank have yet to raise rates yet, the Bank of England have raised rates, the Federal Reserve have raised rates, the Central Bank in Canada, Australia, New Zealand, they've all hiked rates. The European Central Bank hasn't raised rates yet, but they've given a very clear indication that they're going to hike interest rates by 25 basis points next month. And also there's even talk of speculation of a large rate hike coming in September. So the German economy, the largest economy in the Eurozone, that's cooling. And Germany is about to experience an increase in the cost of borrowing, along with the rest of the Eurozone, and then possibly another large increase in the cost of borrowing in September. So what's that going to do to the German economy? If you're already going downhill growth-wise, momentum-wise, what's going to happen when you start hiking up interest rates? Looking at the price action here in the last few hours, to be fair, this candle here, like I saw on the DAX, the Dow Jones rather, was fairly bullish. This candle here has a potential to be what's called a bullish engulfing. For those of you who study and read about technical analysis, you possibly heard the term bullish engulfing. If you haven't heard the term bullish engulfing before, I would Google that. I would look up. I would Google the term bullish engulfing, and it's one of the more kind of common price patterns you see within technical analysis. And essentially, in order for a bullish engulfing to be confirmed, you would need to see the price continue to move higher from here. But they're often typical reversal indicators to say the market's about to turn around. If the market does turn around, it could be either the market turns around for a while before it falls lower again, or it could be the beginning of an overall turnaround where the market just spins out in the other direction. Essentially, the fact that this body here completely engulfs this red rectangle here kind of speaks to how quickly sentiment turned around, and the fact that this candle here, this body completely engulfs this, overshadows it, engulfs it completely, kind of eclipses it. That goes to show you how quickly sentiment has swung around. If we do rally from here, where we look at targeting, where we could look to head back down towards the 20 period moving average, which comes into play at 12,986. If you follow that moving average around, you can see it acted nicely as resistance here. It acted as support here. It acted as resistance along here. It acted as support here. Didn't sort of acted as resistance zone here in mid-June. And as I said before, when a metric has been of importance in the past, it makes it more likely to be of importance in the future. And why is that? Because some people out there are rightly or wrongly, some people out there are big believers in moving averages. And if they've spotted that this moving average has a pretty good track record of acting as resistance, they might look to open fresh short positions when the market rises to that moving average. Conversely, people who are buying the dip and buying the dip. People who are buying the dip and have spotted the market's turning around. If they bought the DAX down around here, they might be then thinking to themselves, where am I going to exit? The market's in a downtrend. I'm going to buy it as the market ideally turns around. The market will rally a few hundred points, then I exit my long position. And if they're thinking to themselves, right, the market's still in a downtrend, if I'm looking at closing my long position because I bought the dip, where would I want to exit my long position? And they might look at moving averages and go, well, the market has a history of struggling to break above the 20 period moving average. So I might put my limit to take profit to close out, to sell the market, to close up my long position at or around where the moving average is. And that's how technical analysis can become a bit of a self-fulfilling prophecy, which some people describe as a flaw in technical analysis. I actually think it's actually a positive thing. But there you go. So if we do rally from here, I'll be looking out towards this moving average here, the 20-period moving average. Once again, to remind you all, I'm looking at the 4-hour time frame here. If the market does break above the 20-period moving average and we start to have a fairly large rally, where could we target? Well, I'll be looking at targeting these peaks here are 13,362. There's a few occasions here, this general zone acted as a resistance area, kind of acted as a barrier to the market rising. So if we break above that, that'll be fairly significant. And the last chart that I'm planning on looking at anyways, unless of course you want me to look at anything else, is UK oil. So the first and foremost, the news from earlier on today, OPEC Plus, the body that is quite influential, shall we say, in the production and supply of oil. They came out and they said that from August, their production will be ramped up to almost 650,000 barrels of oil per day. There'd be a production increase of 648,000 barrels per day, meeting expectations. And whenever they actually bring that about, then we essentially begin to August, September. And at that point, OPEC Plus will have completely undone the severe production cut it announced in the summer of 2020, when they decided to cut production by almost 10 million barrels of oil per day. Because obviously back in, say, April, May 2020, we were still amid the first lockdown, and demand for oil, because of industries being closed, fell off a cliff. And as a response to that, OPEC Plus did a massive cut in production as a way of kind of supporting the oil market. And over the last couple of years, 18 months, 2 years, they've been slowly but surely ramping up production on a kind of monthly or a bi-monthly basis. And then whenever they do this final increase in production, they'll get it back to the pre-pandemic level of output. So that was expected. But as I've been mentioning in previous charts, recession fears are hanging around. If some countries enter a recession and many countries go into an economic slowdown, you'd imagine industry is going to be a bit weaker, as is manufacturing, and in turn demand for oil is going to fall. So hence why we have seen a bit of weakness in oil recently. Oil has held up fairly well in the last few weeks when compared to industrial metals such as copper or silver falling to a 2-year low. Why is this? Well, the fact that supply in the grand scheme of things is still fairly squeezed. Russian oil is kind of essentially being penalized, being embargoed. OPEC Plus haven't been as, there's been numerous times that they haven't even met their own target of ramping up production. So supply is squeezed. So when the price of a commodity is high, you might say, oh, it could be down to one or two things, or a mixture of both. Very strong demand, that isn't the case because the global economy is clearly cooling. Look at the perception of demand levels for silver at a 2-year low. A while ago, we had copper at a 16-month low, and we've seen multi-month lows or even multi-year lows in several industrial metals in the last few days and week. Whereas oil is still holding up fairly well, not because of demand, because of squeezed supply. Because if this low that we set here about a week ago was a 1 month low, then we had a very large rally, and now we appear to be moving lower again. The question is, does this short-term downward move extend, and then do we retest the recent 1 month low, or do we actually kind of properly shake that off, break above this peak here, and look to test these peaks along here? But given the fact that OPEC Plus won't be doing a massive power ahead in output, they're going to basically stick to their original plan. It was always the plan to get back to pre-pandemic levels of output by September 2022. That's still very much on track. While UK oil continues to hold below these 3 simple moving averages, I suspect that the more medium-term bearish trend will continue. The RSI is moving lower, suggesting the price bias is to the downside. The monthly indicator shows that momentum is firmly in negative territory, indicating that the bears are in control. If we do move lower from here, I'm looking down towards 105.80, and then below that down towards 104.69. Keep in mind, this low that we set here was a 4-week low, and if you break below that, that'll be fairly significant, because then we'd be in the territory of creating, you know, a new 5-6 week low. And if you go below, say, you know, 104.70, probably kind of, you know, down towards $100 is probably what people would be looking for. Obviously, oil obviously has its own geopolitical issues that are hanging around oil, but I'm very interested to see how oil can manage to hang around fairly elevated levels when other commodities that are essential in heavy industry and manufacturing, silver, copper, and the likes, are either at, you know, multi-year lows or close to multi-year lows. So that's what I'm kind of watching out for UK oil. You know, if we do see a continuation of the more medium-term rally, where can we go? The first big level I'm watching out for is this peak here at 115.88, and then of course if we clear that, that'll be fairly significant, because then we're in the process of, you know, creating about a 2.5-3 week high, and that could be the indication that the much broader longer term trend, the longer term uptrend, is still in effect. If we do break above this peak here, I'll be looking up towards 118.95, and then beyond that, up towards 120 is the next level I'll be watching out for. Any questions, anyone? Any markets? Anything? Any questions on what I've covered, or any markets that I haven't covered that you want me to take a look at? If there are no questions, I'll look to wrap things up now. Just to let you know, I'm on Twitter, and I'm fairly active on Twitter in terms of, you know, doing tweets about what's going on with financial news, showing off various different charts, and you know, writing some commentary about what I think is potentially going to go on with the charts. For those of you who run Twitter, if you want to get in contact with me via Twitter, feel free to follow me. Feel free to get, you know, tweet at me and say, hey, how's it going? What do you make of this news? Or what do you make of this chart? Or what's your opinion on UK oil, or whatever it might be? This here is my Twitter handle, at @dmadden_equity. So feel free to get in touch via Twitter. Now, obviously, I can't give any advice. I can't or won't give any advice, but I'll happily just write, you know, do a tweet or respond to in a similar fashion what I've been covering in the webinar. You know, where I typically talk about what's going on with the overarching trend. I talk about if in this example, if the downward trend does continue, these are the price levels that we could potentially find support at. If the downward trend were to reverse and were to rally from here, where could we go? And then I'll mention a potential area, a couple of resistance areas. US 30, I think, fair, I've already covered the US 30, but I'll very quickly briefly go over it again. The big picture view for the US 30 is to the downside. If you look at that trend there, it's clearly very much to the downside, especially if you go on a daily chart here, it becomes much more apparent what's going on. One thing I will say about, you know, markets in general, whatever time frame or frames you typically look at, be it, you know, 10 minutes or half an hour or an hour or 4 hour, whatever it is, always spend a bit of time looking at the longer time frame. If you typically trade off an hourly chart, be sure to look at the daily chart and the 4 hour chart and the daily chart, because for all you know, there's a big picture trend going on that you can't see on the shortened time frame. You know, or for example, you know, this is what I mean is, probably give you a good example now. If you look at, say, the 5-minute chart of the Dow Jones, you would look at this and go, wow, that's a very aggressive move higher. We had a sharp move to the downside. We've moved aggressively higher here. That looks to me as if the market's in a fairly strong upward trend. And looking purely on that metric, on that chart alone, I would agree with that assessment that the market's moving aggressively higher. But if you zoom out to a 1 hour chart, you then see that all of a sudden this upward move is actually fairly small in the grand scheme of things. And this is what I mean about the difference between a 5-minute chart and a 1 hour chart can show you a lot what's going on. Because sometimes, in my opinion, and my experience, you need to be looking at the bigger picture, and you need to be always conscious of the bigger picture. Sure, I get it. If you want to trade a 5-minute window and that's what you're happily going to be in the market for 20 pips and then in 20, out 20, all that way along, grand. But you have to be conscious that there are trends within trends within trends, and you need to be kind of figuring out what is the overall view, because broadly speaking, the overall, the longer term trend tends to win out. So I'm going back to the US 30. In the last few hours, we've been rallying, but the rally of the last few hours needs to be put in context of the fairly large losses that we've seen in the past 2 or 3 sessions. We're below all 3 simple moving averages. Momentum shows us that it's firmly in negative territory still. So it seems to me as if the bearish trend is going to continue moving lower from here. I'm looking towards 30,250, 30,259, and a break below that, 30,000 itself will be the next big number to watch out for. And if you go below that, I'd then be looking at retesting the lows of mid-June. If this short-term rally can be sustained and it continues from here, I'm looking toward these peaks here, which all kind of are in around the area of 31,158. And then if you break above that, the next big one to watch out for will be this peak here at 31,883. I was asked there about US dollar versus the Japanese yen, dollar yen coming up. So the Japanese yen is an interesting currency, because the Japanese yen is typically seen as a flight to quality play, in that whenever people or investors and traders are fearful about the health of the global economy, i.e. stock markets are falling, oils are falling, metals are falling, which we're seeing a lot of today, when that happens, the Japanese yen typically rises. So some people out there, if anyone is out there and trades the Japanese yen, you need to be always looking at what's going on with the markets as a whole. What's going on with stocks, metals, and oils. It doesn't make a difference if you trade them or not. That's fine, but you need to be paying attention to what's going on in the other markets, because if they have an aggressive move and they're all moving lower, for example, as they are today, chances are the Japanese yen will be moving higher. And conversely, in periods where stock markets are booming, industrial metals are flying, oil is strong, you often see the Japanese yen being weakened because people are taking money out of safe haven assets such as the yen and plowing it into riskier assets such as stocks. One of my experiences, a lot of people spend too much time kind of in their own kind of silo, as it were, in that they'll say, oh, I only trade currencies. I don't like stock market indices. I don't like metals. I don't like oils, and they never pay attention to them. You need to be looking at the financial markets as one aspect as a whole, and gauging the sentiment in the overall market. So I talked to you a few minutes ago about the US dollar was strong, and the US dollar is strong. So it was only yesterday we saw the dollar yen hit another 22 year high or 24-year high. It hit its highest level since 1998. So almost, so we're talking, over 20 years, 24-year high was posted only yesterday. So that really tells you how strong dollar yen is in the kind of grand scheme of things. That being said, we have seen a pullback. Why do we see a pullback? Well, a minute ago, we just talked about how the Japanese yen is a very much a risk-off currency. So this is what I mean about if you're trading the dollar yen, you always have to be kind of paying attention to what's going on with stock markets. Are stock markets falling? If they're falling, chances are the yen's rising. So that being said, I think the kind of big picture view is still clearly to the upside for dollar yen. It was only yesterday we hit a new multi-decade high, which, as I mentioned, the big trend typically wins out. So the long term, so if anything, the pullbacks we're seeing in dollar yen, right now, and for all we know, it could fall further. That could actually, we could see some dip buyers enter the fold. Let's face it, buying the dip has been a fairly popular strategy with the dollar yen currency pair over the last few weeks. So if they get a longer term trend does continue, where could we go to? Well, I'll be looking up towards kind of 138, and then 140 will be the next big level to watch out for on dollar yen. To the downside, where would I be looking to? Well, first and foremost, I'll be looking down towards kind of around, say, 135-ish, thereabouts. I'll be looking towards 135, and then below that, possibly down, because if you look, 135 is where the 100-period moving average comes into play. And as you can see here, it acted, nicely as support here in late May. It's been a long time since we've even retested the 100-period moving average, which in itself says a lot about how strong the market is. Because when the market sells off, it doesn't even get down there. So we can see here in mid-June, when we had an aggressive move to the downside, even then it got close-ish to the 100-period moving average, but then it quickly rebounded and went on to hit a new multi-year high. So I'm looking towards 135 to the downside. And if you go below that, the next, it'll only be, from as far as I'm concerned, only a mild concern. The next big level to watch out for on dollar yen will be 134.23, the lows here of latest June in the last week or 10 days, because that's the last big low that we saw before the market at this rally here, which culminated with the new multi-decade high. And then of course it's only becomes a bit of a worry for dollar yen if we're to kind of break below the lows here of mid-June, and that's in around the kind of 131.50 zone. I'll be conscious now that I've been talking now for over 40 minutes, so I'm looking to wrap things up now. So once again, I do want to apologize for anyone that was waiting at the very beginning. It's annoying that my earbuds let me down right on the hour, but I do appreciate it for those who've stuck around, and also thanks for the individual you asked about dollar yen and also the Dow, because it's always nice to have a bit of interaction. Do you trade crypto? Do you think I don't actually have on this particular platform that I'm using here, I don't actually so far have access on this particular platform. I don't have access to the charts of Bitcoin, so I'll have to kind of talk about it in a more kind of generic terminology. Bitcoin has dropped below 20,000, and I can't remember off the top of my head, but it's certainly a multi-month low, if not even a multi-year low, has been posted. So the kind of big picture trend for Bitcoin is to the downside. But this is what I mean about looking at the markets as a whole rather than just being specialized in one thing. It's good to have a handful of markets that you like to trade, but it is also worth your while spending a bit of your time looking at what's going on with the overall view. Keep in mind, it's no coincidence that, say whatever it was, say 6 months, probably about 9 months ago, or really 12, 15 months ago, when investment sentiment was at its absolute peak, Bitcoin was booming, industrial metals were strong, and oil was strong because everyone thought the global economy is going to be booming. And in turn, stock markets were strong. All those four asset classes, crypto, metals, oil, stocks, what do they have in common now? They're all falling, because it's now about kind of switching over to assets that are considered to be lower risk, and people are kind of are cashing in their chips and running. That being said, some assets fall further than others. So if you were to look at, say, trading crypto, or if this is a theory I'll apply, or a measurement I'll apply to all markets, if you're looking at how good or how strong of a market is, a decent measure is how little it falls during an overall sell-off. So if you were to sit down and look at the price action of Bitcoin versus Ethereum and Ripple and Litecoin and other various different coins, I think you'll find the likes of Bitcoin has probably fallen the least. So if there's a brutal sell-off in the cryptocurrencies across the board, the weakest of the cryptocurrencies will probably fall the most, and the strongest and the most popular currency will probably actually fall the least. In relation to the price action of Bitcoin, to be honest, I'm a bit surprised that it got down to this level this quickly, because it was only a few weeks ago Bitcoin was around $40,000 a coin, and then it quickly got to $30,000. There was a fair bit of support in around $30,000, because the last when we had a large sell-off in Bitcoin about a year ago, or 15 months ago, there about 30,000 acted as support. Now we smashed below that. We're back below 20,000. So once again, when you're looking at a chart as a big picture, always ask yourself the question is, I know this is dollar yen, look at the price action, you know, on a kind of on a 4-hour, 1-day, 1-week chart, and going to go ask yourself the question, what is the market telling me? And the kind of the longer term trend for Bitcoin, well, at least for the more medium term trend, I guess, because in the last few months at least, or under a year, it's been moving aggressively lower. And until we see a sharp turnaround in Bitcoin and a sustained rally, I suspect that the more medium term bearish trend that we're witnessing is going to continue. So I'll look to wrap things up there because it's now, I've been speaking for about 45 minutes. Once again, I do appreciate those individuals who got in contact with me and asked about what's going about other markets. It's always fun to have a chat about something else. Once again, a quick reminder: I'm on Twitter. At @dmadden_equity is my Twitter handle. So feel free to get in contact on Twitter and ask questions. I'll look to wrap things up there. So everyone, thank you for your time. Have a good trading week, and I'll speak to you next Thursday. Thank you very much.